Hi guys and welcome back to the Mindful Investing channel. Today I want to show you how you can buy stocks at a discount using put options. Before we jump into the strategy, we need to first understand options. So let's start with the question, what is a put option? Put simply, a long put option is the right to sell 100 shares of stock at a predetermined price at a future date. As always, to acquire this right, we need to pay a price. This price is called the premium. Let's look at an example. Apple currently trades at around $150 per share. Let's say we buy one put option contract to sell 100 Apple shares at $140, that's the strike price, on 1st of January. For this put option, we pay, let's say, $3 per share. So fast forward to expiration date. Let's say Apple still trades at $150 per share. Now the right to sell 100 shares of Apple at $140, so basically our put option contract, is worthless because why should we sell 100 Apple shares at $140 if we could just sell them at $150 on the market? On the other hand, let's say Apple trades at $130 per share at expiration date. Now our put option will be $10 in the money because we have the right to sell 100 shares at $140 while the current stock price is only sitting at $130. We will therefore make use of our right to sell Apple shares at $140 per share and exercise our put option. If we deduct the premium we paid to go along this put option, so basically $3 per Apple share, our net sale price per Apple share will be $137. Whilst long put options are primarily used for hedging purposes, they are not of use for us to enter positions at a discount. To enter positions at a discount, we will need to sell a put option, so basically go short a put option. To understand a short put option, we simply need to inverse the long put option we just looked at. So if a long put option is the right to sell 100 shares at a predetermined price at a future date, a short put option is therefore an obligation to buy 100 shares at a predetermined price at a future date. For ensuring to buy those shares at a certain price in the future, we receive the premium. So let's look at the Apple example again. Let's say we sold a put option that expires on 1st of January with a strike price of $140. For selling this put option, we received $3 per share. If Apple continues to trade at $150 at expiration date, the put option won't be exercised and we therefore keep the $3 premium we received and don't need to buy any shares. If Apple trades below $140 at expiration date, the option will be exercised and we buy Apple shares at $140 per share. Because we received the premium of $3 per share, our purchase price will be roughly $137 per share. We are therefore able to acquire Apple shares at a discount of $3 to the current stock price of $140. To increase the probability of us being able to acquire shares at a discount, we usually choose strike prices that are closer to the current stock price or are already above the current stock price, so basically in the money. This way we can also maximize the premium we receive for those put options. So let's say instead of selling put option at a strike price of $140, we sell an Apple put option at a strike price of $155 that expires on 1st of January. For selling this put option, we receive a premium of $10 per Apple share. So if Apple continues to trade at $150 at expiration date, we are assigned 100 Apple shares at $155 per Apple share. Because we received the premium of $10 per Apple shares, our net buying price will be at $140 per Apple share. So we're able to acquire those shares at a roughly 3% discount to the current stock price of $150. So finally, let's have a look at the real life example. A couple of weeks ago, I sold a put option in One Water Marine at a strike price of $35 when the stock was also trading at roughly $35. For selling this put option, I received a premium of $6.24 per share. So assuming One Water Marine continues to trade below my strike price of $35 until April 21st with its expiration date, I should be able to acquire One Water Marine stock at a hefty discount. To calculate this discount, we once again simply deduct the premium I received for selling this put option from the strike price of the put option and divide by the share price at the date I sold the option. When doing so, we realized that I'd be able to acquire those shares at a roughly 18% discount in April. And in my opinion, an 18% discount for waiting roughly 160 days is quite fair. Before this video comes to an end, let's also shortly discuss what the downsides of the strategy are. Because the stock price of the stock we want to acquire through this option strategy could move above a strike price until expiration date, there is the risk that we are not assigned those shares and therefore only end up with receiving the premium. Turning back to the real life example, even if One Water Marine would trade above $35 strike price at expiration, I would have still pocketed the $6.24 premium per share. Because I only need to set aside capital in the amount of the strike price of the option, less the premium I received, so roughly $28 per share, I would still be able to achieve a satisfactory return of roughly 22% until April, so the expiration date of this option. So I will either acquire the shares I want to acquire at a hefty discount, or I will be able to still achieve satisfactory returns. A part of the risk of not being assigned the shares you wanted to acquire, there's also the risk, like with every stock strategy, of the stock declining sharply. So let's assume One Water Marine drops to $20 per share until expiration. If we would have bought the shares outright at $35 per share, we would be down $15 per share now. Because the premium we received for selling the put option lowers our cost basis, we would only be down the $15 less the premium we received. So using this put option strategy, we can lower our downside risk while still maintaining high upside potential. That's why it's one of my favorite option strategies. And that's about it for today's video. Thank you all for watching. Please feel free to ask any questions in the comments and leave a like if you enjoyed the video. See you next time.